Welcome back to CAIIB Guru, your learning partner for cracking the CAIIB exam with clarity and confidence. In today's class, we're going to understand an important concept under credit risk modeling, rating migration. This concept plays a key role in assessing the creditworthiness of borrowers over time and is essential from both the exam and real-world banking perspective. Let's get started. To begin with, let's ask a very basic question: what exactly is rating migration? Rating migration simply means the change in the credit rating of a borrower over time, using the same rating model. So we are not switching the model or rating system, we are consistently applying the same framework at two different points in time. Let's take a simple example. Suppose a company, M/SXYZ Limited, was rated as B+ based on its financial and business position as on March 31, 2016. Now, 1 year later, on March 31, 2017, we rate the same company again using the same model, and now the rating comes out to be B. This downward shift from B+ to B is what we refer to as a migration. It could be upward or downward, both are part of rating migration. Now the next question is, why should we even care about this migration? If it's just one account, does it really matter? Not really. A single account migrating from one rating to another doesn't tell us much. But when we observe this migration across a large number of accounts, it becomes meaningful. It helps us identify patterns, particularly related to defaults and risk levels, and it also tells us how reliable our rating model really is. Let's look at a simple scenario. Suppose we have 100 borrowers who were all rated on March 31, 2016. We rate these accounts again on March 31, 2017. Here's what we find. One borrower is now rated A++. One is rated A+. 79 remain at A. 10 have moved to or++. 4 to B+. 3 to R. And 2 accounts have defaulted. This table represents the rating migration for these 100 rated borrowers. The most obvious insight is that out of 100 rated borrowers, 2 have defaulted. This implies a 2% default probability for borrowers initially rated as A. That's powerful information. Now, if we extend this exercise year over year and collect such data for each rating category, we can build a fairly accurate estimate of the likelihood of default associated with each rating. This becomes the foundation of default probability models in credit risk management. Here's where it gets really interesting. What if our model gives a much higher default rate than what is generally accepted in the market? Let's say external rating agencies like CRISIL or ICRA report that rated borrowers typically have a default rate of just 0.2%. But in our internal model, we are seeing a 2% default rate for the same category. That raises a red flag. It shows that our model is not as risk sensitive as it should be. In such cases, regulatory authorities, rating agencies, or even the market may consider that our rated borrowers are more accurately equivalent to B+ in the external models, because B+ is where the 2% default probability usually lies in standard models. This process of aligning internal rating outcomes with external standards is known as mapping. It's essential for model validation and credibility. Regulators and rating agencies don't just accept any model at face value. There are two critical criteria they use to assess the quality and acceptability of a rating model. First, the model should cover all relevant risk drivers. This means it must assess areas like management quality, financial health, past conduct, business model, and industry risks. A model that ignores any of these key areas is considered incomplete. Second, the migration patterns observed through the model must align reasonably well with the migration data published by accredited rating agencies. If your model consistently shows a much higher or lower default probability compared to market standards, it's a sign that your model may be miscalibrated. Let me ask you something important. How do banks assess the risk that a borrower may default on a loan? That's where credit risk models come in. Credit risk models are mathematical frameworks that help banks evaluate, monitor, and quantify the risk of default across borrowers, portfolios, and products. They consolidate risk data, estimate both expected loss, EL, and unexpected loss, UL, and support everything from loan pricing to capital allocation. They're not just theoretical. These models directly impact how a bank operates, especially under regulatory norms like Basel II and Basel III. Why are credit risk models important? These models are used to centrally consolidate credit risk data, estimate expected and unexpected losses, support RARIC, risk-adjusted return on capital, feed into pricing, stress testing, and capital computation. So the key point is, credit models are at the core of credit risk management in any modern bank. Now the question is, what types of credit risk models are commonly used in the industry? Let's look at three important ones. Altman's Z-score, Credit Metrics by JP Morgan, and Credit Risk Plus by Credit Suisse. We'll begin with Altman's Z-score. This model predicts the likelihood of bankruptcy within the next 12 months using 5 financial ratios. It's an accounting-based model that uses data like working capital, retained earnings, and market value of equity. It gives an early warning signal. If a borrower's Z-score is low, it indicates high financial distress. It's simple, objective, and particularly useful for quickly scanning the financial health of a firm, especially in manufacturing or non-financial sectors. Next, we have credit metrics. Unlike the Z-score, which focuses on bankruptcy, credit metrics evaluates how the value of a credit asset changes due to credit rating migrations, that is, whether the borrower's rating is upgraded, downgraded, or defaults. This model treats credit risk similarly to market risk by modeling volatility in asset values. It helps banks estimate portfolio value at risk, VAR, due to changes in credit quality. It's used to promote transparency, support economic capital estimation, and align with risk-adjusted return measures like RARIC. Now let's look at Credit Risk Plus, developed by Credit Suisse. This is a statistical, actuarial-based model. Unlike credit metrics, it doesn't consider credit migrations. Instead, it directly focuses on default events. The model uses a default rate and computes a loss distribution to estimate expected loss, unexpected loss, and conditional value at risk. It's a favorite under the AIRB, Advanced Internal Ratings-based, approach because once a bank gets approval, it can use this model to directly compute its regulatory capital, without relying on standardized risk weights. Key outputs include the loss distribution curve, conditional VAR, and risk-weighted assets, which are central to Basel compliance. So now the next logical question is, how do internal risk rating systems work alongside these models? Before feeding anything into a model, banks need to classify borrowers based on their creditworthiness. This classification is done through internal credit rating systems. These systems provide a single-point indicator of borrower risk. They ensure consistency in credit decisions, help with pricing and loan structuring, and enable portfolio monitoring. What makes a good risk rating system? A sound internal rating system has the following qualities. It reflects underlying credit risk clearly. It is standardized across segments like corporates, MSMEs, and retail. It includes both quantitative and qualitative factors. Let's break that down. Quantitative inputs include financial ratios, historical performance, future projections and sensitivity to shocks. Qualitative inputs include management quality, industry trends, business model viability. Together, these form a borrower's risk score or grade. Why periodic review is important. But no system is perfect unless it's updated. Over time, economic conditions change. A business that was safe last year may be high risk this year. That's why periodic reviews and recalibrations are a must. This ensures that your internal ratings are aligned with actual default behavior and can be trusted when used as inputs in advanced models like Credit Metrics or Credit Risk Plus. Let's quickly recap what we learned today. Credit risk models help banks estimate and manage risk across portfolios. Altman's Z-score, Credit Metrics, and Credit Risk Plus are 3 key models. Each serves a different purpose, from predicting bankruptcy to calculating loss distributions. Internal risk rating systems feed critical inputs into these models and must be carefully designed and maintained. These tools are not just theoretical. They impact everything from loan pricing to regulatory capital to bank strategy. That's it for today's session. If you found this session helpful, make sure to like this video, share it with your fellow aspirants, and subscribe to CAIIB Guru for more concept-based lectures that simplify complex banking topics. Keep learning, keep growing.